How to Trade Forex, Lecture 11. And in this lecture we're going to look at two more subjects. Firstly, Bollinger Bands. Earlier in the course you put them in place. Now we're going to find out how they're used and how they work. And when I began trading, I only used Bollinger Bands. They were my only technical tool. And they helped me to make a lot of money in a very short space of time. The second subject for this lecture is gaps and gap trading. You'll soon understand what they are and hopefully see an opportunity to make some money using that. So let's get into Bollinger Bands. Nothing to do with the Bollinger Band champagne. These are to do with a guy called John Bollinger who invented this particular indicator. He's still around today, still very active in the trading world. Technically speaking, these bands put a moving average in place that is two standard deviations either side of a 20-period moving average. There are some numbers in there that can be varied. So I'm talking about a 20-period moving average. That could be a different number. It could be 10, it could be 50, it could be anything. But I exclusively use the 20-period moving average, and that is the default for Bollinger Bands. I suppose it would also be possible to use a different number of standard deviations rather than two, but again, the standard and default is 2, and I use that exclusively. In practice, you don't need to understand really how they're formed or what a standard deviation is. The most important thing is to know how Bollinger Bands behave and how they can help us to make money. Earlier in this course, we looked at putting the Bollinger Bands in position, but just as a bit of revision, let's do it again. We're going to use them now. So we simply go to the Insert area at the top of the trading platform, look for indicators, come across to the trends, and there they are, second down, Bollinger Bands. We get the chance to change things on this. First of all, the periods and the shift, ignore all of that, the deviations. We are going to stick with what's there already, 20, and the deviations is a reference to standard deviation. I'll explain a bit more about that when we see the lines in position. And we can also change, if we want to, the colour or the thickness of the lines. I think for the purpose of this demonstration, I will actually thicken the lines up a little bit to make them easier to see. And we press OK, and there they are in place. And immediately you can see there is some magic going on here. Now, the lines were invented by a guy called John Bollinger, and he's still around and still practicing. And I've read his work extensively, and I can tell you that it is very good, but he doesn't use these bands in the same way that I do at all. And the way I use them is going to appear very straightforward and simple compared to what he actually does. But let's start. You can see we've got here, first of all, the central line, which is actually a 20-period moving average. We're currently on the 1-day chart, so each of the candlesticks is 1 day, and that line, the middle line, is following a 20-day moving average of the candlestick values from top to bottom. The outer lines are 2 standard deviations, which is merely a statistical measure away from that center line. Quite frankly, we don't need to understand standard deviations or anything else. We need to know simply how can we use these lines. And let's begin to see what we can see. So first of all, we've got the Bollinger Bands acting as a pivot point. And this is a pivot point which is not necessarily at a whole number line, so it's come down. We've also got that center line being used as a barrier, again, in between the whole price point lines. And again, uses a barrier at the bottom, and then we've gone up to the top. The candlestick here hasn't broke clear of the middle. This one has slightly, but it was on its way back down again. It's used as a pivot point here, and here again, and here again. Once it's left, we can see the price action moves away from the Bollinger Band at the top, hesitates around the middle, continues on, and this time it's done what I call walked right down that line. It came away from it, but didn't actually make it to the middle again, continued on, and it's actually continued right down that line. But that's on a day chart, and it depends when we are trading whether we're taking a long-term view or a short-term view. I actually start, when I'm placing trades, with a 1 minute view. And here we are. So the Bollinger Bands work in exactly the same way on a 1 minute view. And what I'm looking for is to see where the price action is at this current time. And we have come through a period where it's been at the top, it's hesitated at the middle, it's come down to the bottom, and it's sort of bouncing in between. So at the moment, it's indeterminate on this particular chart. It's not at the top and bouncing, it's not on the bottom and bouncing. If anything, it's perhaps moving towards that bottom Bollinger Band. So I've got a bit of a view forming here that the price is coming down. If I go to the next time period, which is a 5 minute chart, I can see that it actually looks a lot more clear. We are coming down towards this bottom band. However, we are at some points of resistance going along here. So it's got to break through that, perhaps. So I want to take the 15 minute chart with the Bollinger Bands and see what's happening there. And here again, it's still really walking along the middle. So as far as this chart's concerned, at this point in time, I would not be going ahead and placing either a buy or a sell trade. I would simply be waiting until things settle down a bit. Now, while we're here, I'll just go again to the 1 hour chart, and we can see again that it is indeterminate. So in order for me to take the Bollinger Band as a decision-making tool to either enter or equally to leave a trade, I want to see a clear signal from at least those first 3 time periods, and preferably more. Now, while we're here, I also want to point out to you another phenomena on the Bollinger Bands, and that's this area here, where we've got the bands running very close for quite a period of time, some hours in fact. And this is termed a Bollinger Band squeeze. Now, squeezes are quite difficult. If I'm in a trade and I've got a 1 hour timescale chart with a squeeze on it, then I don't know what's going to happen. So I don't know when this squeeze is going to end, and I don't know at the end which direction the price is going to move in. However, what I do expect statistically is that when it comes to an end, there will be a big price movement. We can see across here there's been a squeeze here, and there's been a big price movement. Now, I haven't set these charts up today to be able to particularly demonstrate this. I've just randomly opened the charts to record this video to show you what's happening. But we've got a squeeze there, which is up. We've got another squeeze here, where the following action is a big move down. You could even term that one as being a small Bollinger Band squeeze, and it's gone up. And if we look at other time periods, this is actually monthly. We've got a squeeze in there. We've got exactly the same phenomena, walking down the lines, bouncing off the upper and lower lines and so on. Weekly, same again. There's a little bit of a squeeze there, but it is quite a minor one, but nonetheless came to an end with a big move down. The day chart shows us no good clear examples there of squeezes, but lots of good movements and pivoting. The 4 hourly chart in a series of squeezes, and at the end of each one, significant move down, significant move, this one down, significant move down. So it's working there. The hourly chart, the same. 30-minute chart, very clear one here, the same. And the 15 minutes, exactly the same. 5 minutes, not a very clear one there. And back to the 1 minute. So that's how I use Bollinger Bands. So firstly, I'm using them to look for confirmations on price direction. And we're back on the 1 minute chart. Just to go back, we were here talking about this not long ago, and I was very unsure and hesitant and saying, well, it hasn't really gone and hit the bottom yet. I don't know what it's doing. Since then, while we've been talking, it's actually gone up and hit that middle band. and it's going up from it. Now, I don't know where it's going to go next. It may go through, or it may walk along the middle, or it may bounce off. So this, as a signal, is not strong enough in itself to give me cause to enter a trade at that point. Let's see what's happening on the 5 minutes while we're in. The 5 minute chart, we've clearly broken through the middle. Now, we've broken through the middle, but in terms of reading the Bollinger Bands, I don't class us as having broken through the middle until we've got a clear candlestick away from the line. So, for example, here we've got breaking away from the middle and a candlestick which is absolutely clear, not touching the middle line or any of the lines at all. That to me would say, yes, I've broken away from the line, and I would expect a downward trend to continue. Here we haven't broken through that. We may well do it on the next candle, but we haven't yet. And on the 15-minute candle, again, we're not clear of that middle. So it's not a clear signal. But just going back for a moment to our 1 minute chart, let's see where it's going. Again, still unclear. We've had a few minutes of talking and sorting things out. I've just come back to see what happened with the Bollinger Band and the price action where we were talking about it. So we're now looking again at the 1 minute chart. The area that we were previously talking about this was down here. And this is where we're saying we were hesitant. We didn't know what was going to happen next. In actual fact, what happened, it turned round, went through the middle, and we said we're not sure, it hadn't actually cleared the middle, but here it had. So it's now broken free from the middle, and even though it's come sort of back down and around, it continued that movement up to the top line. It's bounced off the top line. If we see what happened on the 5 minute chart, it's more clear again. It actually did go straight up and get to the top and hit it there. And the 15 minute, it's still on the way up. So that's probably not a trade that I would have actually taken, but you can begin to see how I read and understand these charts and how I'm looking for clear signals. You can also see that we're going to need some additional tools to help us with this. The good news is that we've got some excellent ones still to come. So you're beginning to see how I use Bollinger Bands to trade. They're not my most important tool, I wouldn't say, but they did start off as my most important tool. When I started trading, these were the only tools that I actually had. These were the tools that I used to take my account from £1,800 to £70,000 in a few months. So the Bollinger Bands can be very, very powerful. And now a little bit of revision and a couple of extra points to be made on the subject of gaps and gap trading. I'm going to talk about gaps and trading gaps, taking advantage of gaps, and also a little bit of knowledge which will help us to react properly to gaps that we might see in trading. Firstly, what is a gap? Well, gap is just a very descriptive term for an area like this, where we've got a definite space, a gap between two candlesticks. So you've got the close of one candlestick here, and if you take the wick of it, it's up here, but a gap to the opening of the next one, which is actually up here and came down. And there is a gap. Okay? We can only see that one gap. This is a 1 day chart, and we're going back here probably 100 days, and we can only see one gap. So as far as a 1 day chart's concerned, they are pretty rare. If, however, we were to look at 100 days in terms of 1 minute or 5 minute charts, we would see a lot more gaps. The reason for that is that gaps tend to close. The market does not seem to like gaps in between candlesticks, and therefore generally it will close them. So let's have a look. If we go to the 1 month chart, we can see all the gaps that have occurred going right back to January 2006 were eventually closed. There are no gaps there existing. On the weekly chart, there are no gaps. We've got that small one on the day chart which was closed, and we go back to hourly. It's probably the very same one. We've got one there. That's 4 hours. 1 hour, probably the same gap there, but it's looking more significant. and within periods of less than that, we can't actually see any gaps that have occurred, and there's certainly been none in the last few minutes. So let's concentrate on the gap that occurred here in the 1 hour chart. And by the way, if we put our cursor on the bottom of the candlestick where it's a downward candlestick, we get a lot of information about it. We get the time and the dates, and we also get the opening, high price, low price, the close, and also the volume. And you might want to note there that the time given is on that particular candlestick was 2300 hours. That is, however, the time in Europe. It's not the time where I am in the UK, so I need to take that into account, and you need to take into account and adjust your thinking for the time that you're actually in. On upward candlesticks, just to finish that, we need to put the cursor at the top to get the details there. So let's see, this one again, it was on the 17th of August, today's the 21st, and it occurred at the close of business. The candlestick before that was on the 15th of August, and that was at 9 o'clock, also the closing time of the market. So what happened here was a gap in between close of business on Friday night and opening of business on Sunday night. So that wasn't really a gap, because what actually happened was prices kept changing and the world kept turning, but our trading platform wasn't available. Nonetheless, the market still treats it as a gap, and we can see that although it took several hours, that day, same day, we go on to the bottom of that candlestick, we can see it was, probably this one's actually fairer, it actually closed on the 19th at 10 o'clock, so really it was the next morning by the time it had actually closed. And that's normally the case. I would say that something like 7 out of 10 of gaps that occur are closed pretty quickly. So that tells us a number of things. First of all, if we are putting a trade on and we're in a buy trade and we're up here, we can expect that it's going to go down at some point. So if we get the chance, we might want to come out. Secondly, we can take advantage of it. If we're watching the screen, and a good time to do it is on a Sunday evening when the market's just about to open again, and we see a gap open up like this, it would have opened at the beginning of the hour, so at the top here, that would have been an opportunity for us to place a sell trade and for us to then take advantage of the closing of the gap and to get out when it was coming out. We would use other tools. So, for example, we'd want to make sure that the Bollinger Bands and also Jeff's lines, which you haven't come to yet, and also the rule of thirds, which you haven't come to yet, were encouraging us to trade in the right direction, or the same direction as was required to close this gap. But there's a very sneaky little opportunity there, which regularly comes up on a Sunday evening. So that's gaps and how gaps behave.